Salesforce is an incredibly strong company for you to consider in your portfolio, and they just recently started paying out a dividend. So let's find out in today's episode why it is a very strong company. We're going to take a look at the historical performance. We're going to look at their strong revenue growth year on year, as well as their bottom line net income growth. We're going to look at the health of this company, their total cash versus their total debt, and we're going to compare their performance over the last 10 years against some well-known companies in the industry. And as always, we're going to look not just at their dividend safety, but also take a look at some important financial metrics. Now, they did just recently start paying a dividend, so whilst we can't look at the score, we can take a look at a lot of the information that does back up how safe this dividend is. We'll also look at insider movement, any insider buys, any insider sells, and the same to go for the institutions. And there are a lot of important things that we want to pull out from their latest investor presentation. A lot of growth for this company, and we don't see that stopping anytime soon. As always, we're going to run them through the valuation model. We want to get to our own intrinsic value. We want to see what our own acceptable buy price is and see whether or not Wall Street also believe there is a lot of strong upside. And in today's episode, we are going to take a look at 3 different outcomes for this company, a low growth rate, a medium, and a high, to understand where the valuation is coming from. So let's get straight into it. Now, Salesforce is a company that has performed very strongly, up 57% over the last 12 months. We do see it trade towards the upper end of the 52-week low with a yield of around 0.13% and a forward PE just over 30. Now, over the last 5 years, it is up around 92%, and over the last 10 years, if you have been a shareholder, you would be up a very strong 437%. So let's take a look at the numbers behind this company. Now, in terms of revenue growth, what we typically want to see, however, that is for more mature companies, 3 to 7% growth year on year. What we see for Salesforce, ticker symbol CRM, 5.4 billion reported revenue in January 2015. Latest annual accounts, 35 billion. So that is a lot of growth. They've essentially 7 times their top line over the last 10 years. And this is a phenomenal graph. And I'm about to show you a breakdown of this quarter on quarter, which is going to blow your mind. They are increasing their revenue at a very strong rate. This is definitely a company that you should really consider for your own portfolio. In terms of the bottom line, how does that compare? Well, in fact, in January 2015, they did report a net loss of 263 million. In their latest accounts, as we can see here, a net profit of 4.1 billion. However, when we do take a look at the graph, we can see it is very inconsistent, although we do note in their more recent year, they did report a very strong net profit, and we will take a look as well at their forward guidance. So how does the health of the company compare? Well, we want to look at their total cash versus their total debt. Essentially 995 million of cash in 2015. Latest annual report, so this is their cash and short-term investments, just over 14 billion. So their cash balance as well as their revenue is something that has been increasing over the longer term. So let's compare this to their total debt. So we have cash just over 14 billion. In terms of their total debt, well, it has gone from around 1.5 billion to around 13.5 in their latest annual account. So their cash is more than enough to pay off all their total debt, but we do see the balances are roughly similar, and we also note their total debt has also increased over the last 10 years. No red flags whatsoever. It does look at a high level, a fairly strong balance sheet. In terms of their performance over the last 12 months, well, we can take a look at some of their competitors in the application software industry. We have SAP, we have Adobe, Intuit, and a few others. So over the last 12 months, we do see CRM. This includes their dividends reinvested, the best performing, up 58%. When we take a look at the last 5 years, again, they are very strong, up 92%, although we do know, in fact, they are one of the lower performing at that point. And when we extend it to the last 10 years, we do see, again, they are, in fact, near the bottom. So what that highlights as a whole, this industry over the last 10 years has performed very, very strongly. And something that we always like to highlight, especially to new viewers, is that past performance is never an indicator of future performance. So do bear that in mind when we do look at our analysis, as a lot of it is historical data. So growth grade A-, so that is fairly strong. If we look at their revenue growth, well, year on year, just over 11%, much higher than the sector median of 4%. Revenue growth forward looking again, which we will touch upon, it is higher, 10% versus 7% of the median. So we can see a lot of these metrics are very strong, and as you see when you do compare it to the median for the industry, they are significantly outperforming on nearly every single metric, hence why they do get that grade of A-. Now when we look at something very similar for profitability, A+, this is incredibly strong. Their gross profit margin is 75.5%. The sector for the industry sits at 48%. EBIT margin 17%, above again the sector median. And when we look at their bottom line net income margin, just under 12%, whilst the majority in the sector coming in at around 3%. So this is definitely a company you do want to keep on your radar. Now, when we take a look at insider ownership, fairly high, 3.7%, higher than what we typically see on the channel. 872 million, however, worth of insider sales. We do see no insider buys over the last 12 months. And when we take a look at this in granularity to see the sales, in fact, the large majority of this is being driven by the CEO several times over the last few months, with the latest, in fact, being the 5th of April, so just a few days ago. He did sell for around 4.5 million. Now, we always do say this, it is important to understand just because insiders sell, it shouldn't scare you off stocks. There are no reasons that we know why insiders sell. They don't exactly explain it, but it could be for personal reasons, financial reasons. The only thing we would say is that we do believe that when insiders buy, it is a very bullish signal, but as always, being transparent to show you both buys and sells. In terms of institutional ownership, 80.43%. 24.4 billion worth of sales by the institutions, but more than 3 times worth of buys over the same time period. So institutions are loving this stock. Now, when we do take a look at Q4, we see more buying than selling. When we take a look at the latest quarter, again, we don't have the full data set, but we do see a little bit more selling than buying, 45 million versus 5, with the largest buy being, in fact, Q2 of 2023. So overall, yes, insiders are selling. Institutions have also sold more in the latest quarter, but overall, institutions are buying more than they are selling. Just something to consider within your own investment thesis, your own investment analysis, and as always, do your own due diligence. Now, before we look at the investor slide deck, a few things to highlight. We just want to point out that we have released our latest free weekly article. If you want to gain access to it, as well as all of these other articles, all completely free, do click on that pinned comment below where you can sign up and you can start reading straight away. So the first thing that we do want to highlight from their latest investor slide deck is the disaggregation of the revenue over the last year. So we can see their income streams split into these different levels. In terms of sales, we do see growth of around 14% year on year. When we look at any services they have, again, year on year, 14%. Platform and other, 32% year on year. Marketing and commerce, we're talking double digits in every single income stream. So they are continuing to grow. And when we did take a look at those metrics, this is a company that is fast growing, as we are about to find out. When we take a look at the revenue by region as well, what we can see here is that they are growing in every single region by strong double digits. Americas 18%, EMEA 19%, APAC plus 18%. So this isn't something that you shouldn't put away. You should consider it, and we will take a look, as important as it is, to focus on the valuation. We also want to point out something that is very, very interesting to know. If you were to take a look at this company, you can see quarter on quarter. So if we go Q1 FY21 and keep going across, but do bear in mind they have also their full FY. Every single quarter, near enough, they are increasing, not just over the year on year, but when you take a look quarter on quarter, this company is increasing their top line number from the previous quarter. So that I thought is very impressive, just to show you, as it is something that is very rare to find in other companies. Even if they do grow year on year, this is a company that grows in granularity as well, quarter on quarter. Finally, what is quite important to note is taking a look at their full year guidance. And what they are expecting is year-on-year growth of around 10% to their top line, which we did think was quite important to show that they are also thinking ahead for FY24, that they are expecting this company to continue the strong growth that they have had. And do bear this in mind, as we will now factor this in when we do take a look at the metrics. So in terms of the metrics, as we mentioned earlier, they did just recently start to pay a dividend, so we don't have a full score yet. Market cap, 293 billion. They are a mega cap company. And when we take a look at the payout, it is around 13%, so very, very minimal. We will expect this company to be increasing those dividends at a very fast rate, double digits at the bare minimum, given how low this really is. And when we take a look at the free cash flow per share, very, very strong, consistent growth over the longer term. 2025, they are expecting the same as well. So this isn't a company that is slowing down as well. And this is shown when we do take a look at their sales growth. They have had double-digit growth every single year. Granted that we can see it has been declining over the longer term, 11% in 2024. But as we just went through their guidance, they are expecting for the next full year to increase by around 10%. It is decreasing, so again, we do need to factor this in, but it is increasing quarter on quarter, and just because they are decreasing to 10% in FY25, it doesn't mean 26, 27 and beyond, it is going to start to slow down. Total sales then, just to see it numerically how rapid this rise has been. One thing that we're not the biggest fans of is that their shares outstanding has been increasing as opposed to reducing. We would love to see them return a lot of that excess cash back to the investors. But again, important to understand that they are diluting your position if you were a shareholder since 2015. Now, in terms of the ROIC, now 10% or more is our typical theme for companies. We do know there hasn't been the greatest when you look back over the last 10 years. Really, only the more recent year at 8% is what we like to see, close to that 10%. So something that we would keep an eye on moving forwards when they do release their quarterly earnings as well as their annual reports. Operating margin, now again 2015 to 2022, pretty poor. We do see 6% in 2023. We ideally want to see around that 16% or more, which we do see in FY24. Hopefully this will continue, given that they are rapidly increasing their top line. We would also like to see the margins increase as well. Free cash flow margins, no worries whatsoever. In fact, it has been increasing over the longer term, ideally anything over 7%, and Salesforce has smashed that year on year, 28% in FY24. Finally, the net debt to EBITDA, the earnings before the interest, tax, depreciation, amortization. Remember, this essentially shows us the number of years it would take the company to pay off all of their debt net of cash on hand. 0 in 2024, 0 expected next year, so it won't even take them one day to pay it all off. Their balance sheet is very, very strong, and for those that were worried about the dividend, absolutely no worries there. So overall, this is a very strong company. So let's jump into the valuation. As always, if you do enjoy the content, value is being provided. Smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, with the growth rate, we have gone for around 12% forward looking. Now, we do believe that is around the medium estimate. Based on 12%, we get essentially the free cash flows as we can see here. And in conjunction with the discount rate, we get the present value of those free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding, and as we can see here, an undervaluation signal. So we have the market value of around $300 with the expected intrinsic value of $365 having our undervaluation signal. Now, people will say, oh, that's too high, even though that the average growth rate is 31%. The last 2 years are very, very strong as well. So for those that want to be more conservative at 10%, we can see intrinsically the value would be around 317, still showing some undervaluation signal. So for 10% upside of 6%, for 12% upside of 22%, and for those that believe even the 12% that we just showed was too conservative, at a 14% rate, which we put in today's episode as high, the intrinsic value would come to $420, effectively showing us that there is 40% upside over the period. Now we're going to take through to the final slide, the 12%, as we have gone as a medium level. But for those that are interested, want to grab a copy of this intrinsic value calculator, do click on that pinned comment below where you can run your own numbers, or you can get to the intrinsic value of companies in your own portfolio or even those on your watch list. So with the discounted cash flow valuation coming at $365, we then use essentially our margin of safety, and this is a percentage. So we always start off with 10%, and we do execute on that if we believe it meets certain criteria. That is, if it has a wide moat, strong financial metrics, and good forward-looking data. So at 10% MOS level, it would be a buy up to $329. At 15%, a buy up to $310. At 20%, it isn't quite there yet, so we do see a very healthy 15 to 20% MOS level based on our estimates and judgments. Now, when we compare that to Wall Street and their forecast, well, their price target is $350, slightly lower than our intrinsic value. They see around 17% upside over the next 12 months. So they do also believe this is a fairly strong buy now. As always, though, do let us know your thoughts in the comments below. This has been a very highly requested stock. If there are any other stocks that are highly requested, we can also run them through the valuation model. But let us know your thoughts. Is CRM one you're looking to add? Is it maybe one you have on the watch list, you're waiting for a certain price? Maybe you want a higher MOS level, so at 25% it would be a buy up to 274, and at 30% around 256. Let us know your thoughts in the comments below, and if you did enjoy the episode today, smash that like button, hit that subscribe and bell button, and as always, we'll see you all on the next one.